Hey everyone, this is Lauren Mack with Hacking the Rat Race. Today I'm going to go over different real estate investing strategies and how you can use them to retire early. I absolutely love real estate investing and have been investing in real estate for over 13 years. And it is one of the fastest ways to retire early, so let's jump right in. Throughout history, investing in real estate has generally been considered a good investment for many different reasons. Real estate tends to appreciate over time, even though there are some short-term downturns. However, if you're investing over the long term, you can make good money when it comes time to sell. Despite a few hiccups, the average sale price of homes in the US has increased every year between 1963 and 2007. 2007 was obviously the Great Recession. During this time, home prices did take a hit, but they recovered by 2022, and home prices have reached an all-time high. Of course, now we're facing record high inflation, interest rates are going up again, which makes mortgages more expensive, and that has brought home prices down some. But just like in the past, interest rates will go back down sooner or later, and housing prices will recover and continue to climb. Real estate is also a great way to diversify your investment portfolio. Holding hard assets such as real estate can be a great way to help mitigate risk and overcome the effects of inflation. In times like we're in now, where we have high interest rates and falling house prices, rents are on the rise. Another great benefit of investing in real estate is that it can help you offset your tax liability through depreciating the house over time. So with this in mind, let's talk about some of the ways to get started investing in real estate. The first method that I'm going to talk about is what is commonly referred to as the BUR Method. The BUR Method is an acronym that stands for Buy, Rehab, Rent, Refinance, and Repeat. It is a strategy that is used by investors who wish to create passive income over time. This acronym, BUR, BRRR, stands for the steps that are usually implemented in the order that they appear. Step 1. An investor purchases a property that they begin to rehabilitate. The newly renovated property is then rented out to tenants for an extended period. The rental income from this property can enable the owner to pay the mortgage, earn profits, and build up equity in the property over time. Once a sizable amount of equity in the property is built up due to either an increased value resulting from the rehabilitation project or just with normal appreciation over time, the investor can then purchase a second property by refinancing the first and repeating. This is a great strategy for investing in real estate and is practiced by many real estate investors. However, there are some things to keep in mind before jumping in. One of the biggest considerations in deciding if the BUR method is right for you is asking yourself whether or not you're willing to take on a rehab project. This is the most intensive step required by the BUR method. If you're new to real estate investing, then I would recommend getting a house that only needs cosmetic updates like bathroom, kitchen, flooring updates, not necessarily a big project like knocking down walls and starting from scratch. Investors without the time or dedication to the project required to see the renovation through to the end will struggle to succeed with this methodology. When we've done rehab projects in the past, we've done some of the work ourselves, such as painting, flooring, minor updates, and then hire professional contractors with a good reputation to do some of the bigger projects. This has worked out well for us in the past. So if doing renovations does not sound like something you're interested in or seems overwhelming, then I recommend finding a contractor or contractors that you trust. However, when you're following this method, always make sure you run the numbers before the purchase. This includes how much you're paying for the property relative to the updates you're going to have to complete. And then, what will the value be once the work is done? Additionally, you want to look at the monthly mortgage payment and expenses like HOA costs relative to how much you can get for the monthly rent. I can't stress enough that the numbers should dictate all of your decisions. Using this method to retire early, you'll want your passive income from rents to exceed your monthly expenses. We discuss this in more detail later in the video. If you're getting value from this video, don't forget to poke the like button. This leads me to the next strategy, which is house flipping. You've probably heard about this one before or seen shows on HGTV where they take an old house and turn it into a dream home. House flipping is a process of finding a house that might be old and run down, buying it, renovating the home, and then putting it back on the market, usually within a few months or two, and selling it for substantially more than you bought it for. There are a few key elements necessary to make this strategy successful. First, you have to have a keen sense of the real estate market in your area and what you can realistically expect to make in profits on the house flip. You also need to be able to easily identify what needs to be rehabbed on the property, what it will cost, and how quickly the project can be completed. Having good project management skills is essential. Another essential part of this strategy is having a team of reliable contractors that you can work with to get the rehab done professionally and quickly. I've seen house flippers work incredibly efficiently and can turn a house around on the market probably within 30 to 45 days with a house that looks amazing. Another reason these flips have to be done quickly is that they're often financed through hard money lenders or short-term loans. And if you're a flipper and you get stuck holding a property, even for several months, you can lose a lot of your profits due to holding costs and generally the higher interest rates associated with these loan types. People that know what they're doing can make considerable amount of profits, especially in hot real estate markets. But as I mentioned, it can often come with some risks. Something else to consider when using this method is the short-term capital gains taxes on the profits you make. Again, knowing how much the rehab will actually cost, plus the value post-renovation is important in making this strategy successful. In order to retire early from this method, ultimately, you'll want to invest your flipping income into something that will produce passive income, and again, you'll need to have your monthly passive income exceed your monthly expenses. The next method I'm going to talk about is the buy and hold method. This is exactly what it sounds like. You find a property that's either undervalued or you think has a good chance of appreciating significantly over time. Then you buy the property, rent it out, and hold it until it finally appreciates to the point where you want to sell it and make a profit, or some people decide to keep them forever and just live off the passive income. The difference between this method and the BUR method is there are no renovations. This strategy works well because, as we've discussed before, real estate has a tendency to appreciate over time. Oftentimes, foreign investors will buy real estate in the United States as a place to park their money. They know that over time the property will increase in value and their money is kept relatively safe. At some point in the future, they can sell and make a substantial profit. Many investors in the US will buy a property, rent it out until the tenants ultimately pay off the mortgage, and then the investor will have a nice passive income stream at retirement, or they can always sell the property and take the profits. Another great thing about this method, as opposed to flipping, is the long-term capital gains are lower than short-term capital gain taxes. Another option available once the house is paid off is the investor can choose to sell the house via rent-to-own method. In this case, the investor will sell the house to an individual and the investor will act as the bank. They will require a down payment from the buyer and then the buyer will make monthly mortgage payments to the owner. This strategy has certain tax benefits as the seller can spread out the capital gains over the length of the contract. Before I get to the next method, which does not require a down payment, I want to hear from you in the comments below. What is your target retirement age? Now, if you don't have money for a down payment for a property, or you're trying to figure out how to get involved in real estate investing without having a lot of money, then I suggest you look into wholesaling. Real estate wholesaling is an investment strategy in which a wholesaler sells a property on behalf of the owner for a profit. The wholesaler and seller establish a contract between them, which the wholesaler ultimately sells to another buyer. The wholesaler doesn't actually purchase the property. Rather, the contract with the owner gives them the right to sell it on their behalf, which enables the wholesaler to keep the profits for themselves. For example, a wholesaler might agree to buy a property for, let's say, $200,000 in 90 days. The wholesaler will then find a real estate investor who agrees to buy the property for $225,000. So the difference is $25,000. This is known as the spread, and it is what the wholesalers profit. The key to successful wholesaling is having the ability to find off-market properties and also having a network of interested real estate investors. Being successful at this strategy also requires being good at marketing and networking. One way people often find off-the-market deals is they find houses that have been for rent, that are sitting on the market for a significant amount of time, and they offer to buy the property from them. Another strategy, just to let people know that you're interested in purchasing homes. Maybe someone you know might know someone who wants to sell but does not want to deal with all the hassle. Many people who want to get into real estate investing but don't have money for a down payment start by wholesaling to build up some cash, and then they can purchase their first house. Additionally, through wholesaling first, you set yourself up to get the best deals off the market before anyone else. The next way to invest in real estate that I'm going to talk about today is probably the easiest method. It does not require any knowledge of property rehabbing or collecting rents, and that is to invest in a REIT, which is a real estate investment trust. A real estate investment trust is made when a corporation or a trust is created and then uses investor money to purchase, operate, and sell income-producing properties. REITs are similar to stocks as they are bought and sold on major exchanges. So, if you ever bought a stock, then you'll be familiar with how to invest in REITs. In order to be designated as a REIT, it must pay out 90% of its taxable profits in the form of dividends to shareholders. This enables REITs to avoid paying corporate income tax, whereas a regular company would be taxed on its profits, therefore reducing the returns it could distribute out to its shareholders. REITs are a lot like regular dividend-paying stocks. They are perfect for investors who want regular income, and they also offer the opportunity for appreciation. REITs invest in a variety of properties such as malls. Actually, about a quarter of all REITs specialize in these. Healthcare facilities, mortgages, and office buildings. So REITs can be a good strategy for those who want to invest in real estate but earn income like a dividend-producing stock. However, since REITs avoid paying corporate income tax, the money that is passed through to you in the form of a dividend is also taxed differently than normal dividends. Investing in REITs is a very popular investment vehicle, especially for passive income. However, I always recommend people talk to their accountant or CPA before investing in a REIT, just to understand the way they can impact your annual taxes. In order to retire early, you could use one or more of these methods, but how will you know when you're able to actually retire? The first thing you want to do is determine your monthly expenses. Then you'll know how much you'll need to cover your monthly expenses. However, when investing in real estate, and especially if you're planning on retiring early using your real estate, I recommend having a large emergency fund for repairs and vacancies, in addition to your regular emergency fund for your own expenses. I aim to have at least 3 months of mortgage payments, plus 1 to 2 large repairs for each house. The chance that all these will hit at the same time is small, but it will ensure you have plenty of a cushion and you don't have to stress. Once your monthly expenses are covered by your passive income and you have sufficient emergency funds, then you're able to retire. The best thing about this is that you're not only able to retire on monthly income, but your houses are slowly appreciating over time and the tenant is paying down your mortgage. This in turn grows a nice nest egg and increases your net worth. If you want to retire early, but you're wondering how much money you should have saved for retirement at every age, check out this video right here.